Imagine it's 8:29 a.m. on a Tuesday. You're sitting at your desk, your trading algorithms are just humming perfectly.
Right, everything's green.
Exactly. Everything is green. You've spent weeks building what you believe is this mathematically flawless, rigorously back-tested options strategy. And, you're up 14% on the year. The charts look beautiful, and you finally feel like you've decoded the matrix of the stock market.
It's the best feeling in the world. Until it isn't.
Yeah, right up until exactly 8:30 a.m. because that is when the Labor Department releases a Consumer Price Index report, the CPI, and it comes in just, 0.2% hotter than anyone expected.
And in the span of maybe 60 seconds, literally every single assumption you made just evaporates.
It's terrifying. Your screen turns this violent shade of blood red. The entire market panics in unison. All those individual company fundamentals you spent hours studying, they just don't matter anymore, and your pristine, unsinkable strategy just gets completely wiped out.
It takes a massive chunk of your portfolio straight down to the bottom of the ocean with it. It is the absolute definition of a systemic macro shock.
Right.
And really, it's the exact moment that separates the tourists from the professionals. Because when a macroeconomic bomb goes off like that, the market completely stops trading on logic or earnings potential. It just starts trading on pure, unadulterated liquidity panic.
Which is exactly our mission for today's deep dive. We are taking a really close magnifying glass to a masterclass in quantitative options trading, and we're relying on some incredibly detailed strategic breakdowns from the exact days surrounding that May 2026 CPI shock.
Yeah, it's a perfect case study.
It really is. So our goal today is to unpack how you actually survive that terrifying 8:30 a.m. moment of market chaos, and then I think more importantly, how you turn that survival architecture into a massive offensive advantage.
We are going to be dissecting the microscopic plumbing of the market here. So that means exploring this architecture of survival, breaking down the psychology of risk and decoding the incredibly complex, often totally misunderstood world of right-skewed implied volatility.
And finally, we'll be synthesizing all of that into this cross-asset momentum framework known as VPED, which, if you don't know, is essentially a radar system for tracking exactly where institutional smart money is flowing.
Exactly. So whether you're an active trader desperately trying to figure out, how to protect your capital from these random macro shocks, or
if you're just someone listening on your commute who's intensely curious about the hidden mechanics of the stock market, like how billions of dollars actually move behind the scenes.
Right. Either way, this deep dive is going to hand you a completely new lens. You're going to learn how to stop trying to predict the news and start structuring your survival around the actual physics of the market itself.
And the foundational rule of that physics, like the core concept we absolutely have to accept before we do anything else, is the admission that during a black swan event, every single technical indicator you rely on will just fail you.
Completely fail you. Yeah.
Let's hover on that for a second, because I know a lot of people who swear by their charts. But when panic hits, the sources note that things like moving averages, the RSI, Bollinger Bands, they all just snap. Why is that mathematically inevitable?
Because those indicators are built on the assumption of a normal distribution of historical data.
Right.
Take the RSI, the Relative Strength Index. It measures the speed and magnitude of recent price changes to sort of evaluate overvalued or undervalued conditions. But, it assumes a functioning market where buyers and sellers are negotiating price based on a company's actual worth.
Like a rational market.
Exactly. But when a CPI shock hits, the correlation of all risk assets essentially goes to 1.
Meaning everything just moves together in a synchronized plunge.
Precisely. It is a mad rush for the exit door. So a Bollinger Band might tell you that a stock is 3 standard deviations below its normal price and therefore due for a bounce.
But it doesn't matter.
It doesn't matter at all, because a liquidity panic is, by definition, an event outside of normal standard deviations. Buying a stock during a macro shock just because a lagging indicator tells you it's oversold, it's like standing on train tracks and trusting that the oncoming freight train will stop just because it's technically scheduled to be at the station.
Oh, wow. Yeah, the train doesn't care about the schedule. So if the charts are useless, the only thing that keeps us alive is what the sources call a survival architecture. And the first pillar of building this bunker is physical isolation, or premium capping. They detail this very strict 0-to-0 budget.
Yeah, and this is your absolute first line of defense against catastrophic ruin.
Yeah.
It really requires a complete psychological shift in how you view your trading capital.
So, okay, if I have a dedicated, say, $10,000 budget for trading options, and to be clear, this isn't my retirement account, this is my active risk-on capital.
Right. Your entertainment budget, basically.
Yeah. The architecture dictates that if I want to buy a call option on a major tech company like QCM or DL, my position size should strictly be 1% to 2% of that budget. So that's what, $100 to $200?
Exactly.
I look at that and think, man, if I've done all this research and I have massive conviction, putting $100 on it feels like a waste of my time. My instinct is to swing harder. Like, put $1,000 on it.
And that instinct to swing hard is exactly the psychological trap that the market relies on to wipe out retail accounts. You have to treat that 1% to 2% as a literal return to zero budget.
Meaning I have to assume I'm going to lose it.
Yes. The absolute moment you execute the trade and buy that option, you must mentally write off that money as already gone, incinerated.
Because in the options market, unlike buying regular shares of a stock, an out-of-the-money call can literally go to absolute zero if a CPI shock hits.
It doesn't just go to zero, it goes to zero in a matter of minutes because options are decaying assets. If you put, say, 20% of your account into one high conviction play and an unpredictable macro headline drops, you didn't just lose 20%. You severely impaired your mathematical ability to compound your way back to even.
But if I isolated my risk to 1.5%, say $150, and the market cap's down.
You just shrug, you lost $150, big deal. The other 98.5% of your capital is physically isolated.
Sitting safely in something like SGOV, earning a steady 5% yield in short-term treasuries, completely oblivious to the chaos.
Exactly. You've lived to trade another day, you ensured you still have a seat at the poker table, and that is everything.
Okay, so keeping the budget tiny isolates the financial damage, but money is only half the equation when we were talking about options, right? If a macro shock hits, you are also fighting the clock. How much time do I actually need to ride out a panic? This brings us to pillar 2, time redundancy.
Yes. The primary rule here is the absolute avoidance of what the sources call low DTE days to expiration. You must never, ever purchase doomsday options that expire in a week or two.
So what's the target?
The target is always 45 to 60 days to expiration, or even more.
This is where I think of the stock market as an ocean. Buying a weekly option, a contract that expires this coming Friday, is like diving into that ocean and just holding your breath.
That's a really good way to look at it.
Right, because if the water is calm, maybe you swim down, grab a pearl, and come back up. But if a macro shock hits, it's like a massive wave suddenly pushing you 20 feet deeper. You are stuck underwater, the pressure is crushing you, and you simply run out of air before you can reach the surface. You drown. But if I buy an option with 60 days to expiration, I'm strapping on a massive scuba oxygen tank.
That analogy hits the underlying mechanics perfectly, because what that oxygen tank actually provides is the runway for mean reversion.
Let's unpack mean reversion. Why does the market eventually bounce back after these panics?
Because the initial sell-off of a macro shock is almost always a severe overreaction. It's an emotional and algorithmic purge. Large institutions are just shedding risk indiscriminately.
Just selling everything that isn't nailed down.
Exactly. But eventually, the dust settles. The massive funds look around, they look at the underlying cash flows of companies like AMD or NVIDIA, and they realize the actual business model hasn't changed just because inflation ticked up a 10%.
So they step back in and start buying the dip.
They start scooping up these companies at a massive discount, which reverts the stock price back toward its fundamental mean. But that process, it takes weeks.
Right. Yeah.
So if your option expires in 3 days, the CPI data point just killed your trade. You are forced to liquidate at the absolute bottom of the panic. But if you have 50 days left,
I can just sit at the bottom of the ocean, breathe deeply from my tank, and patiently wait for the institutions to repair the chart.
exactly. Time is literally a structural shock absorber.
And obviously, that scuba tank doesn't hold air forever. Which brings up a really fascinating contradiction in the sources. They insist on buying 45-plus days of time, but Pillar 3 of the survival architecture is a rigid 21-day rule.
Oh, this is crucial. It is the most vital and honestly the most ignored tactical discipline in quantitative trading. The rule mandates that if a long option contract reaches 21 days left until expiration, you must close it or roll it out to a further date. No exceptions, no holding and hoping.
Okay, I'm going to play devil's advocate here because this feels deeply counterintuitive. Let's say I bought that 60-day option. A CPI shock hit on day 10, the stock tanked. But now at day 39, the stock is finally starting to rip back upwards. The mean reversion is happening. Why on earth would I close my position and cut my profits just because the calendar hit the 21-day mark?
Because you are about to step into a completely different physical environment. You are about to face the wrath of a Greek letter called theta.
Okay, let's break down SETA. This is the measure of time decay, right? The idea that an option loses a little bit of value every single day just because time is passing.
Correct. Options are fundamentally contracts of probability. The more time you have until the expiration date, the higher the probability that the stock might make a massive, profitable move. Therefore, that time has a tangible monetary value.
Makes sense.
As each day passes, the probability shrinks, and the premium of the option decays. But, and this is the trap that catches almost everyone, theta is not a straight line.
So it doesn't just tick down by like $2 a day every single day?
Not at all. Time decay is a curve. If you have 100 days to expiration, losing one day barely moves the needle. But as you enter the last 21 days of an option's life, that decay curve becomes exponential.
The exponential kill zone.
That's exactly what the sources call it. The last 3 weeks are the exponential kill zone. Every single day that passes eats a massively accelerating chunk of your premium.
So going back to my scenario where the stock is finally bouncing back.
In that scenario, you are fighting a war on two fronts. You need the stock price to go up, but you are simultaneously fighting the exponential gravity of theta pulling the value of your contract down.
Oh.
Even if the stock is slowly climbing, the time decay in that 21-day window is so violent that it acts like a treadmill running backward faster than you can sprint forward. Your option's value will erode faster than the stock's upward movement can replenish it.
That is wild. So I could be perfectly right about the direction of the company. The mean reversion could be happening exactly as I predicted, and I would still lose money simply because I let the clock melt my contract.
You would be functionally right and financially devastating. The 21-day rule is an architectural constraint that ensures you never fight the exponential time war. You simply refuse to participate in that phase of the contract's life.
Okay, if you're listening to this and keeping track, these three pillars are the absolute foundation. Keeping our position sizes under 2% physically isolates our capital. Buying 45-plus days of time gives us the oxygen to survive the initial drop. And getting out before the 21-day kill zone ensures we don't bleed to death from time decay.
Right. That's the bunker.
But all of this is defensive. How do we transition this into an offensive posture? Because when a macro shock hits, the literal cost of playing the game fundamentally changes, doesn't it?
It does. And this is where we have to introduce a concept the sources call tool downgrade, or the mechanics of risk slicing.
Let's contextualize this for the listener. A bad CPI report drops. The market freaks out. The metric we use to measure that fear is implied volatility, or VIV. When everyone is terrified that the market is going to crash, the demand for options skyrockets, which means the premiums, the actual ticket price to buy an option, become incredibly bloated.
Exactly. The fear is priced directly into the contract. So if you try to execute a standard single-leg trade like just buying a naked call option on a stock you expect to bounce, you're walking directly into a pricing trap.
Because I'm paying a massive premium just for the privilege of entering the trade. Like if it normally costs $500 to buy a call on QCOM during a CPI panic, that exact same call might suddenly cost $3,000.
Precisely. And if your budget rule mandates that you can only risk 2% of your capital per trade, a $3,000 naked call suddenly requires a $150,000 total portfolio just to mathematically justify the entry.
Which most retail traders do not have.
Right. So what do? They break their own sizing rules, buy the bloated call anyway, and expose themselves to total ruin.
So how do we get around the bloated ticket price without breaking the rules? The sources point to moving away from naked calls and utilizing a vertical spread, specifically a bulk call spread. Can we do an ELI 5 and explain it like I'm 5 breakdown of how we slice this risk?
Let's use your QCOM example. You want to bet the QCOM will bounce back, but buying the naked call costs $3,000. To construct a bull call spread, you still buy that $3,000 call. But at the exact same moment in the same transaction, you sell another call option on QCOM with the exact same expiration date, but at a higher strike price.
Okay, pause right there.
Yeah.
I'm selling an option to who?
To the open market. You are acting as the underwriter for someone else's lottery ticket. And because you are selling an option, you collect a cash premium up front. Let's say you collect $2,500 for selling that higher strike call.
Oh, I see the mechanics. So I paid $3,000 to buy my call, but I collected $2,500 by selling the other one. My net debit, the actual cash leaving my account, drops from $3,000 down to a highly manageable $500. I just sliced a massive block of bloated risk into a micro unit.
Yes, you drastically reduced your cost of entry, which allows you to maintain your strict 1% to 2% sizing rules even in the middle of a highly volatile, really expensive market.
Okay, but I have a serious bone to pick with this strategy.
I think I know what it is.
If I sell a call at a higher strike price, I am legally capping my upside. If QCMM announces some revolutionary new microchip tomorrow and the stock surges 200%, I do not get to participate in that infinite upside because the call I sold obligates me to hand over the profits past that specific strike price. Aren't I just neutering my own profit potential?
This is the most common pushback we hear, and honestly, it reveals a fundamental misunderstanding of capital efficiency. You really have to ask yourself what game you are actually playing. Are you trying to buy a lottery ticket, or are you trying to generate consistent mathematical returns?
Well, I want the returns, obviously, but I don't like giving up profits.
But you aren't giving them up. You are trading them for probability. By using a spread, you are no longer making an infinite directional bet on the stock. You are making a highly targeted bet on a specific price interval. Yes, your total dollar profit is capped. But look at the return on investment. If you buy a $3,000 naked call and the stock has a great run, maybe you make $1,500 in profit.
Which is a 50% return. That's great.
It is great. But if you bet $500 on a spread and the stock moves up into your defined interval, your ROI on that tiny $500 bet can frequently hit 300% to 500%.
Oh, wow.
Yeah, you're risking 1/6 of the capital to generate a vastly superior percentage return. It allows smaller accounts to step into the ring and trade incredibly expensive heavyweight stocks like Broadcom or Nvidia without over-leveraging.
Okay, that reframing changes everything. I'm trading absolute dollar dreams for mathematical capital efficiency. But the sources highlight another layer to this, right? They call it defensive restructuring, and it involves protecting against something called Ivy crush.
This is perhaps the single most important architectural reason to use spreads during a macro shock.
Let's set the stage again. We're in the middle of the CPI panic. I bought my option when implied volatility, the fear metric, was at its absolute peak. What happens to that volatility a week later when the market realizes the economy isn't actually collapsing?
The fear evaporates. The market exhales. And when fear drops, implied volatility collapses back to its normal historical baseline. That rapid deflation is called 5E crush.
And how does that impact the naked call I bought?
It destroys it. The price of an option is intrinsically tied to volatility, a variable measured by the Greek letter vega. If you were holding a $3,000 naked call and 5 crushes, the fear premium you paid simply vanishes into thin air.
So even if the stock price goes up, I lose money.
You could be totally right about the stock going up, but because the volatility collapsed, the value of your option plunges anyway. It is infuriating.
Wait, so I correctly predicted the bottom, the stock is going up, and my account is still bleeding money.
Exactly. Because you bought bloated Vega and then the Vega deflated. But this is where the absolute genius of the vertical spread comes in. Remember that higher strike call you sold?
The one I collected $2,500 for.
Yes. When the IV crush happens, the entire options chain deflates. So that call you sold also loses massive value due to the volatility dropping.
Right.
But because you were the seller of that leg, an option losing value is highly profitable for you. You sold it for $2,500. Maybe now it's only worth $500. You essentially made $2,000 on the short leg.
Oh my God. The profit I make from the sold leg collapsing perfectly offsets the damage the IV crush is doing to my bought leg.
Exactly. It acts as a structural hedge. By buying one leg and selling another in the same expiration cycle, you effectively neutralize your Vega risk. You strip away the volatility distortion and isolate the trade back to pure underlying price direction.
It's like installing a state-of-the-art suspension system on a car before driving it through a pothole-filled war zone. The car still hits the crater, but the chassis doesn't crack. The structure absorbs the kinetic energy.
That is the perfect way to describe defensive restructuring.
Okay, we've spent a lot of time on the chalkboard. We know the theory of surviving. We know the mechanics of slicing risk. Let's take this into the real world. Let's examine a live, brutal stress test using the specific data the sources provide from May 2026.
I love this part. A black swan event is the ultimate truth serum for the stock market.
How so?
Well, during a normal bull run, a rising tide lifts all boats. Everything goes up, even the garbage companies. But when a violent macro shock hits and liquidity dries up, the market instantly reveals what it truly values and what it considers disposable. We look for the toughness gap.
Let's focus on the semiconductor sector. On May 12th and 13th, 2026, the bad CPI data drops. The market vomits. We are looking at 3 massive heavyweights, Qualcomm, Dell, and AMD. The sources draw a really sharp distinction between the real drop and the deep V resilience. Break down the tape for me.
The divergence on the tape is textbook. Let's start with QCM. On the day the CPI shock hit, QCM suffered a massive 11.46% intraday plunge. It fell off a cliff down to $202 a share, eventually limping into the close around $210. It absorbed a very real, very heavy beating, and it stayed down.
The sellers took control and just didn't let go.
Right. But then you analyze the intraday charts for DL and AMD on that exact same day. When the CPI shock triggered the initial algorithmic selling, DL and AMD also dropped about 7% intraday. But they did not stay down. The absolute moment they hit that minus 7% threshold, a tidal wave of massive buy orders flooded the tape.
Wow.
Yeah, violently reversed direction, forming a sharp, deep V shape on the intraday chart, and managed to close the day only down about 3%.
So if I'm a trader looking at my multi-monitor setup, and I see QCM bleeding out down 11%, but I see DLL and AMD clawing their way back to almost even, what is the underlying machinery of the market signaling to me?
It is signaling immense, aggressive institutional conviction. Those DB recoveries don't happen because retail traders on Reddit are buying fractional shares,
Right, it's not retail money.
Exactly. They happen because the smart money, the multi-billion-dollar quantitative funds and pensions, looked at the CPI panic, looked at the price of DL and AMD, and decided this was a valuation miskill.
A valuation miskill, meaning the baby got thrown out with the bathwater.
Exactly. The institutions knew the macro headline was bad, but they also knew that DL had an absolute mountain of verified backlogged orders for AI servers. They knew AMD's forward guidance on their new data center chips was rock solid. So when the algorithmic panic temporarily drove the price down 7%, the funds didn't view it as a broken fundamental thesis. They viewed it as a rare fleeting discount on a premium asset, and they bought it with both hands.
And QCM, on the other hand, did not trigger that same institutional rescue response.
It did not.
Let's drill deeper into QCM because the sources dedicate a lot of analysis to its specific setup, leaning heavily on a strategy called PEAD, Post-Earnings Announcement Drift. We need to define this before we go further.
PEAD is one of the most rigorously documented anomalies in financial academia. The premise is that when a company reports a massive, unexpected earnings beat, the stock market does not instantly efficiently price in the new information on day one.
Why not? I mean, if the news is out, shouldn't the price instantly reflect the new reality?
You'd think so, but it's because of the physical limitations of institutional capital. If a massive mutual fund wants to increase its allocation in a stock by $500 million because of a great earnings report, it cannot buy all $500 million on day one without rocketing the stock price up and ruining its own average cost.
Ah, of course.
So it breaks the order up. It buys steadily over 2, 3, or 4 weeks. That slow, continuous, massive buying pressure creates a drift upward in the stock price long after the earnings announcement.
Okay, so applying this to QCM. Right before the CPI shock, QCM had delivered an incredible earnings report. The stock gapped up tremendously, and the sources point out that the critical survival line for the QCM thesis was the origin point of that post-earnings gap, which sat at $205.
Yes.
Now, you mentioned QCM dropped to $202 intraday, but it fought back just enough to close the session at $210.31. So strictly speaking, it closed above $205. It held the gap. The survival line was not breached. My question is, does that mean the PZM thesis is still perfectly intact?
Yeah.
Or is an 11% intraday heart attack a flashing yellow light we need to respect?
It is a phenomenal question, and the quantitative analysis required to answer it is deeply nuanced. You cannot just look at the price. You have to look at the volume profile during that 11% drop.
The actual number of shares that changed hands.
Precisely. If QCM dropped 11% on massive record-breaking volume, it means the institutions themselves were hitting the exits. The fundamental thesis is dead.
But what if it wasn't a huge volume?
If it dropped on shrinking volume, which the sources define as volume less than 30% of what we saw on the day of its initial earnings breakout, then the mathematical PEAD logic remains completely intact.
Why? Because low volume implies the big boys weren't the ones selling.
It implies it was primarily retail traders and algorithmic stop losses getting flushed out in a panic vacuum, not a structural abandonment of the stock by the major funds.
Okay, so the gap held, the volume was low, we should be screaming buy, right?
Not entirely. You cannot ignore the context of the toughness gap we established earlier. Because QCM's rebound was so visibly anemic compared to the violent, aggressive snapbacks in AMD and DL, you must tactically downgrade QCM in your portfolio hierarchy.
What does that mean in practice?
It transitions from an aggressive, short-term offensive play into a defensive, longer-term structural play. You don't abandon the trade, but you adapt your architecture. You widen your vertical spreads, and you buy an expiration date much further out to give the institutions more time to accumulate.
I understand the logic. But we need to pause and talk about the human element here, the psychological reality. If I'm sitting at my desk and I just watched a stock I love completely cratered 11% in a single morning because of a random inflation headline, my central nervous system is on fire.
Oh, absolutely.
Even if I check the volume, even if I know the gap held, my primitive brain is screaming at me, if you buy this stock right now, another piece of bad news will hit tomorrow and it will go to zero.
You are describing classic recency bias. When humans witness a traumatic event like a violent market crash, our brains dramatically over-index the probability of that exact trauma repeating itself in the immediate future. It induces a state of physical and financial paralysis.
So how do you hack your own brain? You can't just command your amygdala to stop feeling fear.
You don't hack your brain. You use the architecture to bypass it entirely. This is where you deploy the risk slicing we discussed earlier. You don't buy the naked call, which exposes you to unlimited downside. You construct a wide-width bull call spread. Maybe make the distance between the call you buy and the call you sell $30 to $50 wide.
And how does that alleviate the paralysis?
Because your maximum possible loss is strictly mathematically capped to the tiny premium you paid for the spread. You define your absolute worst-case scenario to the penny before you even click the buy button. But the sources also offer a much more advanced tactical maneuver here called legging out, which is brilliant for managing deep psychological fear.
Legging out. Okay, walk me through the specific mechanics of this.
Let's say it's Friday afternoon. The
Yeah.
CPI shock just happened. You are terrified the market might collapse over the weekend. But your quantitative models say AMD is a buy. So you enter a tightly hedged spread. You buy the call, and you sell a call right above it. You have high vega protection, incredibly low capital risk, but your upside profit is heavily capped. You log off, and you sleep peacefully over the weekend.
Okay, my anxiety is managed. I didn't miss the entry, but I'm wearing heavy armor.
Exactly. Now it's Tuesday of the following week. The market has digested the news, the panic has totally evaporated, and AMD is surging upward on massive volume. The bottom is definitively in. Now, you take action. You leg out of your protective structure. You go into your brokerage platform, and you simply buy back that short call that you originally sold, closing that specific leg of the trade.
Wait, so I leave the original bot call running?
Yes. By buying back the short leg, you essentially rip the roof off your own trade. You shed the defensive armor because the environment is no longer dangerous. You dynamically transform your hedged, capped position back into a pure, naked long call, just in time to ride the massive momentum wave upward with infinite profit potential.
That is legitimately beautiful.
It really is. Yes, you paid a slight financial premium to hold that short call over the weekend, but that was the cost of your psychological insurance. It allowed you to safely enter a trade you otherwise would have been far too paralyzed to touch.
You use the mathematical structure to parent your own emotions, and then you dynamically adjust the structure when the empirical data changes.
Exactly. It is the difference between reacting to the market and engineering a system to navigate it.
Okay, everything we've discussed so far has been from the perspective of buying options, whether naked calls or spreads, but the sources pivot sharply into a totally different paradigm of the market. What if you are the one selling options? Specifically, the art of selling puts.
Selling puts is a massive cornerstone of how institutional funds generate consistent, compounding income. But it is vastly misunderstood by retail traders who often treat it like free money until they get completely annihilated.
There is a very famous, very bleak analogy about this strategy. People say selling puts is like being the guy who picks up pennies in front of a steamroller.
I've heard that one.
Right. You collect a steady stream of tiny little premiums, but if a macro shock hits and the stock crashes, you are legally obligated to buy hundreds of shares of a collapsing company at a terrible price. You get flattened.
While the steamroller analogy is a bit of a cliche, the risk profile is accurate. When you sell a put, you are fundamentally acting as an insurance company. You are selling another trader a guarantee that you will buy their stock at a specific price if the market crashes.
And just like a real insurance company, if a Category 5 hurricane hits, I have to pay out massive claims.
Exactly. Let's modernize the analogy. Think of selling puts like being a catastrophic home insurance adjuster in Florida. For 10 months out of the year, the weather is beautiful and you collect massive, steady premium checks from homeowners. It feels like easy money. But mathematically, that hurricane season is coming. To survive long-term in that business, you cannot operate on gut feeling or optimism. You need a rigorous, emotionless evacuation model.
An exit strategy.
Yes. In options trading, that is called an exit matrix.
So if I am writing these insurance policies, what are the triggers in the matrix that tell me to evacuate the trade?
The sources outline 4 non-negotiable exit triggers. The first is the 50% rule. Let's say you sell a stock, put on a stock, and you collect $1,000 in premium upfront. A few weeks go by, the stock is doing well, and the value of that put has decayed. You can now buy it back to close the trade for just $500. You've effectively captured 50% of your maximum potential profit.
My greedy instinct says, why stop at $500? If I just wait until the expiration date, it will go to zero and I keep the whole $1,000.
Because the hurricane is always forming off the coast. You have already captured half the money, but you are still carrying 100% of the catastrophic downside risk if a sudden CPI shock hits tomorrow. The risk-to-reward ratio has fundamentally inverted against you. You take the 50% win, you free up your capital, and you underwrite a new policy somewhere else.
Got it. Take the money off the table. What is the second trigger?
We return to the 21 DTE rule. If the calendar shows only 21 days left until expiration, you must close the short put.
Now, wait a minute. Earlier, we established that the last 21 days are the exponential kill zone for time decay theta. If I am the seller of the option, isn't accelerated time decay my best friend? I want the option to melt away.
It is your best friend, until you meet its psychopathic cousin, gamma.
Okay, we need to deep dive into this. We talked about delta and theta, but what is gamma and why is it explosive?
To understand gamma, you must first understand delta. Delta is the speedometer of an option. It tells you how much the price of your option will change if the underlying stock moves by exactly $1.
Okay, delta is speed.
Yes, but speed isn't constant. Gamma is the acceleration of that speed. Gamma measures how much your delta will change when the stock moves. And here's the terrifying part for option sellers. In the final 21 days of a contract, gamma becomes hyper-concentrated and nonlinear.
Meaning what in plain English?
Meaning that if a stock experiences even a tiny normal fluctuation in price during those final 3 weeks, the gamma will cause the delta to swing violently. The price of the option you sold will whip around uncontrollably.
Yikes.
Yeah, for a seller who is only trying to collect a small fixed premium, a sudden gamma explosion against your position is catastrophic. The risk of assignment being forced to buy the shares skyrockets unpredictably. You simply evacuate before the gamma storm hits.
Okay, so trigger 1 is 50% profit. Trigger 2 is 21 days left. What's trigger 3?
The IV crush exit. If you act as the insurance adjuster and sell a premium, put right after a CPI panic, you are collecting massive fear-bloated premiums. What happens when the panic fades a week later?
Volatility drops. The fear evaporates.
And the bottom falls out of the options pricing. The value of the put you sold plummets, not because the stock moved, but because the ID crushed. You don't wait around for the rest of the time to decay. You immediately close the position, capture the massive profit provided by the volatility collapse, and move on.
And the final trigger?
The logic-broken exit. This requires brutal honesty. If you sold a put believing a stock had strong support at $200 and it violently breaks below that level on massive volume, your fundamental thesis is dead. You do not hold in hope. You do not average down. You close the position, take the loss like a professional, and protect your remaining capital.
This disciplined approach leads to a concept in the sources that I found absolutely mesmerizing. It is a mathematical framework called yield decay optimization, or analyzing your theta capture rate, the TCR.
This is where we elevate from retail survival into professional capital optimization.
I was trying to wrap my head around this, and I thought of it like a delivery driver getting paid for a route. Imagine you take a job to drive a package across the state. The route usually takes 10 hours, and you get paid $1,000 upon delivery. That is your expected hourly rate, $100 an hour. But today, you find an incredible shortcut, and you arrive at the destination in just 2 hours. You drop off the package and get your $1,000.
Right.
You wouldn't pull your truck over and just sit in the parking lot for another 8 hours just because the original schedule said the job takes 10 hours. You capture the value early. You get back on the road and take another job to compound your earnings.
That is a brilliant way to frame it. The theta capture rate is the mathematical formula that tells you exactly when you have found that shortcut and are being overpaid for your time.
If you are listening to this on a run or in your car, and your eyes are about to glaze over at the mention of a math formula, stay with us. This is surprisingly simple, and it will permanently change how you view your open trades. Walk us through the TCR formula.
The formula is simply your current profit percentage divided by your elapsed time percentage.
Oh,
Let's run a real specific example from the source data to anchor this in reality.
let's do it.
In the provided logs, there is a trade involving SMH, the major semiconductor ETF. The trader sells a put on SMH on April 30th. The expiration date of the contract is June 18th. So the total lifespan of this trade from start to finish is exactly 49 days.
Okay.
49 total days. Now fast forward to May 13th.
hmm
Exactly 13 days have passed since the trade opened. So 13 divided by 49 means that 26.5% of the total time has elapsed.
Right. So logically, if the decay of time and profit were a perfectly straight linear line, I should have captured about 26.5% of my maximum possible profit.
Precisely. But the sources note that on May 13th, the SMH position was actually up 61.71%.
Oh, wow. So the trade is massively ahead of schedule because the stock rallied or volatility
Yeah.
dropped.
Now we calculate the TCR. We take the current profit percentage, which is 61.71, and we divide it by the time elapsed, which is 26.5. That gives us a theta capture rate of 2.32.
What does a 2.32 TCR actually command me to do?
It mathematically proves that your profit is outrunning time by a factor of 2.3. You have captured nearly two-thirds of the total possible value in barely a quarter of the required time. The action is crystal clear. Close the trade immediately.
Don't wait.
Exactly.
Oh,
You do not risk 100% of your collateral capital, keeping yourself exposed to another random CPI black swan for the remaining 36 days, merely to squeeze out the final 38% of the profit. You close the SMH put, you free up the thousands of dollars in margin requirement, and you redeploy that capital into a fresh setup.
it is the ultimate velocity of money. So let's say I execute that. I take the win, I close the SMH trade, and I now have all this freed up capital sitting in my account. I want to deploy it by selling more puts. The sources present a fascinating hypothetical here. They compare selling puts on AMD versus selling puts on Palantir, PLTR. Both are high-flying AI-adjacent stocks. Both have high premiums. But the sources heavily favor AMD. Why?
Because this scenario touches on the deepest, most foundational psychological rule of selling options. Only trade what you dare to hold.
What you dare to hold. Oh, unpack the reality of that.
Remember the insurance analogy. If you sell a put, you are legally obligating yourself to buy 100 shares of that stock at the strike price if the market crashes. The sources openly acknowledge that Palantir has great fundamental momentum, massive commercial revenue growth, strong AI platform adoption, but the stock is historically incredibly volatile. It swings wildly.
Right, it's a roller coaster.
Exactly. The trader in the scenario admits, fundamentally, they would not feel comfortable waking up tomorrow and discovering they suddenly own a massive, heavy, long-term portfolio position in Palantir after a 20% crash.
Ah, if you don't actually want to own the company long term, you have no business writing the catastrophic insurance policy on it.
Exactly. Because if PLTR starts to drop and approaches your strike price, your lack of fundamental conviction will induce sheer panic. You will experience overwhelming loss aversion. You will likely buy back the paddle put at a massive financial loss just to escape the anxiety, or you'll make irrational emotional adjustments that ruin your account.
But with AMD,
With AMD, the trader has deep structural conviction in their data center, server story, and their ability to challenge NVIDIA. If AMD crashes because of a macro headline and the trader gets assigned the shares, they don't view it as a disaster. They view it as, I just got forced to buy an incredible generational asset at a steep discount.
that psychological armor totally neutralizes panic. It keeps your trading mechanics pristine because you aren't operating out of fear.
Exactly.
Okay, this is a phenomenal transition point. If you have been tracking with us, we have completely optimized our defensive bunker. We know how to cap our risk physically, we know how to slice premium costs with vertical spreads, and we know exactly when to evacuate sold puts using the TCR to free up our capital. We are sitting in a fortified bunker, safe from the CPI shock, with plenty of dry ammunition. It is time to step out of the bunker and go on the offensive.
Yes. We are pivoting from the mechanics of survival into the mechanics of extreme aggressive convexity. And to do that, the sources point us toward the strangest, most expensive, and most distorted corner of the stock market, the hunt for right skew.
To understand right skew, we need to map out what the sources call the volatility surface. Let's build this from the ground up.
The volatility surface is essentially a 3D map showing how expensive options are across different strike prices and expiration dates. In a normal, relatively boring market environment, say, looking at options on the S&P 500, the options pricing model exhibits what is known as left skew.
Left skew. Meaning what, mechanically?
Meaning that deep out-of-the-money puts bets that the market is going to suffer a catastrophic crash costs significantly more than equidistant out-of-the-money calls bets that the market will soar. The left side of the bell curve is elevated.
Why? I mean, if the market historically goes up more often than it goes down, shouldn't upside bets cost more?
You would think so, but options pricing is driven by human emotion, specifically fear. Institutional investors hold trillions of dollars in long stock positions. They are perpetually terrified of a sudden 2008-style crash wiping out their portfolios, so they constantly structurally buy puts as portfolio insurance.
Ah, so the demand never goes away.
Right. That relentless structural demand makes puts permanently more expensive. The massive funds are willing to willingly overpay for downside protection. That is normal.
Okay, so puts cost more because fear is fundamentally a stronger emotion than greed. But what happens when things get crazy? What happens when an entire sector loses its mind?
Sometimes a specific stock, or a thematic sector like AI, enters a state of absolute euphoric mania. Suddenly, the entire dynamic of the volatility surface flips upside down. Deep out-of-the-money calls bets that the stock will explode upward by 20%, 30%, even 50% in a few weeks, become wildly, irrationally expensive.
Wow.
Their implied volatility shoots through the roof, pricing far higher than the puts. The curve violently tilts upward on the right side. This phenomenon is right skew or positive skewness.
So the market completely abandons its traditional fear of a crash and instead begins paying massive, bloated premiums out of pure, unadulterated greed and FOMO.
Exactly. It is the real-time pricing of a fat tail bet.
Now, I have to push back hard here, because if I am listening to this, I'm thinking, wait a minute. You just spent an hour telling me to be disciplined, to cap my risk, to manage my time decay, and now you are telling me that the ultimate offensive strategy is to go find the most overpriced, mathematically ridiculous lottery tickets in the entire casino and buy them. Are traders who pay for right skew just stupid?
They are not stupid. They are making a highly calculated attack on the foundational math of the market itself. To understand this, you have to realize that the standard options pricing model, the Black-Scholes model, assumes that stock prices move in a normal, symmetrical bell curve distribution.
Meaning that most days a stock moves a little bit, and massive 20% extreme gap days are statistically incredibly rare.
Right. The model prices options based on that assumption of normality. But sophisticated traders buying extreme right skew are actively betting that the Black-Scholes model is fundamentally wrong in this specific instance.
They think the model is broken.
They are betting that for this specific stock, due to an impending catalyst like an earnings report or an AI conference, the actual real-world probability of an explosive, paradigm-shifting upward move is much, much higher than the standard math assumes. They believe the right tail of the distribution curve is fat.
Even so, paying a massive premium for a deep, out-of-the-money call still feels like gambling.
It looks like gambling until you understand the institutional plumbing operating underneath it. This is not a bet on the company. It is a convexity play. When you buy these bloated, right-skewed calls, you are buying long gamma. You're essentially weaponizing the market makers against themselves.
Okay, we need to completely dissect this. Explain the mechanism of how buying a call weaponizes a market maker.
Let's use a hypothetical AI chip maker. The stock starts to run up. Retail traders, seeing the momentum, rush in out of FOMO and start buying thousands of these cheap, deep, out-of-the-money call options.
Right, and who is selling them those options?
The market makers, the massive algorithmic desks at major banks.
Right.
But here is the critical piece of the puzzle. Market makers are not allowed to gamble. They are strictly regulated, and their risk management protocols require them to remain delta neutral. They only want to make money off the bid-ask spread. They do not want to be exposed to the directional movement of the stock.
But if they just sold me a call, they are exposed. If the stock explodes to the upside, I make a fortune, which means the market maker loses a fortune. They are short the call.
Exactly. So to hedge their massive risk, the moment they sell you that call, their algorithms are mathematically forced to go into the open market and buy actual shares of the underlying stock. This offsets their negative delta exposure.
Wait, let me make sure I understand the causality here. Because people bought options, the banks are physically forced to buy the stock.
Yes, and as the banks buy millions of shares to hedge their risk, what happens to the price of the stock?
The massive buying pressure pushes the stock price even higher.
And as the stock price goes higher, those out-of-the-money calls that everyone bought suddenly get closer to being in the money. The delta of those options increases. And because the delta increased, the market makers are no longer properly hedged.
Oh my God. They have to buy more.
They are forced to buy even more stock to re-hedge, which pushes the price higher, which increases the delta again, forcing them to buy again.
It is a self-fulfilling feedback loop.
It is a violent algorithmic cascade known as a gamma squeeze. When you hunt for right skew, you aren't just predicting good news. You are hunting for a setup where the market makers have poured a room full of gasoline, and you are buying the match. That is what true convexity is. the payout becomes exponential.
That is mind-blowing. You are surfing on the forced liquidity of Wall Street banks. But obviously, there is a dark side. What are the extreme risks of hunting for right skew?
The risk is total annihilation of premium through skew mean reversion, because you are paying a massive bloated premium for this explosion. If the catalyst happens, say the earnings report comes out, and it is merely good instead of world-changing, the gamma squeeze doesn't trigger.
So the stock might go up a little, but
The market exhales, the right skew instantly flattens out, the volatility crushes, and the massive theta time decay eats your position alive. Your premium goes to absolute zero almost instantly. It is a binary boom-or-bust strategy.
So we have this weapon, this hunt for convexity. Where do we aim it? Following the May 2026 CPI shock, the sources actually run a quantitative market scan to find exactly where this extreme greedy right skew was hiding in the aftermath. Let's look at the greed matrix of May 11, 2026.
The sources apply very strict quantitative filters to sift through the noise and find true anomalies. They specifically look for a 25 delta skew greater than 0, a call-put-fort ratio above 120%, and call volume dominating the chain at over 70%. They're scanning for the undeniable footprints of institutional FOMO.
And the number one name that popped up on this scan might surprise people. It wasn't NVIDIA, it was DL. The sources crown it the ultimate lottery skew. Let's break down the data on why DL was the most distorted stock on the board.
The data on DL in May 2026 was historically staggering. The implied volatility rank, the 4 rank, was sitting at 99.04%.
Let's contextualize IV rank. That means that out of the last 252 trading days, the current level of volatility is higher than it has been in 99% of the time.
Exactly. It is at a statistical extreme. But it wasn't just high general volatility. The scan showed massive, coordinated stacking of open interest. Large institutional players were quietly accumulating tens of thousands of deep out-of-the-money calls with incredibly aggressive strike prices way up at $300 to $350, with expiration dates stretching all the way out into December 2026 and January 2027.
I have to ask, why Deal? A few years ago, Deal was just the company that made the boring black plastic monitors in your office cubicle. Why is institutional money paying outrageous lottery ticket premiums for it?
Because of what the sources identify as event-driven skew. DL had an earnings report scheduled for May 28th. The market had completely re-rated them. They were no longer a boring PC company. They had become the indispensable physical plumbing for the entire AI revolution.
They build the actual server racks that hold the NVIDIA chips.
Yes. The options market was heavily pricing in whispers of a massive, unannounced backlog of sovereign AI server orders. The right skew here was the options market screaming, "We believe this upcoming earnings report will be so fundamentally paradigm-shifting that the stock will violently reprice upward by 50% overnight."
It is the absolute highest conviction setup on the board. Okay, what was number 2 on the scan?
QCM. But the sources classify this differently. They call QCM a momentum skew.
Let's look at the numbers. QCMM's IV rank was 97.05%, and their volatility put-call ratio was sitting at 0.23, which is an insanely bullish metric. For roughly everyone put being bought, there were 4 calls being bought.
Yes. The key difference here is that QCM did not have an impending unknown catalyst like DL.
Yeah.
QCM had already reported earnings. The news was out.
So what was driving the skew?
This extreme skew was driven purely by the narrative momentum of their AI mobile chips and swirling rumors of massive, exclusive order blocks from Apple. Traders saw the multi-week momentum, felt the FOMO, and were willingly overpaying for the right tail to chase the trend.
Then the scan looks at NVIDIA itself. Now, if you asked anyone on the street in 2026 what stock embodies pure FOMO and upside explosion, they would say NVIDIA. But the data from the scan is entirely counterintuitive.
It is a great lesson in market efficiency. NVDA's 5-year rank was only 55.58%. It wasn't at historical extremes at all.
Why not? How is the king of AI not exhibiting the most extreme greed?
Because of what the sources term structural skew. NVIDIA absolutely possesses a constant Burr cap. The market perpetually expects it to go up. But because NVIDIA has delivered massive upside surprises so consistently for so many consecutive quarters, the market is completely used to it.
It's priced in.
Exactly. The explosive, out-of-nowhere surprise factor is severely diminished. The premium for an upside explosion is constantly, structurally baked into the everyday price of the options. Therefore, you don't get that sudden, extreme pricing distortion that offers the most asymmetric convexity plays.
Okay, what about a stock that had already exploded? The scan pulls up DDOG. Datadog.
DDOG serves as the cautionary tale in this analysis. It represents post-event flattening. Datadog was already up a staggering 31% following their May 7th earnings report.
The explosion already happened.
The catalyst had passed, the IV crush had already devastated the premiums, the right skew was actively fading back to normal left skew parameters. If you look at the chart, see it up 31% and decide to buy DDOG options now, you have completely missed the party. You're just paying exorbitant fees to clean up the confetti.
Finally, we arrive at AMD. The sources label AMD the second-tier setup, but they seem incredibly bullish on its actual utility.
AMD presents the most pragmatic opportunity. Its IV rank was 65%. It possessed a medium healthy skew, but it lacked the euphoric extreme distortion of DL. However, the deep scan found massive open interest stacking for July expirations, specifically clustered around the $250 to $300 strike prices.
What was the catalyst looming in July?
The Advancing AI 2026 conference. Institutional money was quietly, methodically positioning themselves for a major technological product announcement months in advance.
And because AMD's skew wasn't historically peaked at 99% like DL, it actually offered a much cheaper, more reasonable volatility cost to enter the trade.
Precisely. It wasn't going to explode tomorrow, but it was a highly attractive, mathematically sound midterm target designed to capture future convexity as the July event approached.
So we have laid out all these individual complex puzzle pieces. We know that looking for PED, the post-earnings announcement drift, is basically hunting for solid, fundamental, institutional momentum. And we know that hunting for right skew is looking for pure, unadulterated human emotion and algorithmic gamma squeezes. What if we didn't have to choose between fundamentals and convexity? What if we could weld them together into an apex super strategy?
This is where we reached the pinnacle of the deep dive. Section 7, the synthesis of VPED.
VPED. Volatility-informed post-earnings announcement drift. The academic papers and the sources refer to this as cross-asset momentum convergence. That sounds like the title of a PhD thesis that nobody wants to read, but what does it actually mean in practice?
It means marrying the slow, inevitable, fundamental drift of institutional buying with the violent, explosive, nonlinear payout of the options market.
Let's break down the logic of why this marriage is the holy grail. We know the weaknesses of both individual strategies now.
Exactly. Pure PED relies on institutional reaction deficiency. It's great, it's steady, but it's slow. It is a long, multi-week drift upward. Conversely, pure right skew is a highly dangerous fat tail bet. It relies on retail FOMO and market makers being forced into a gamma squeeze. It is violent and fast, but if the explosion doesn't happen, theta time decay wipes your account to zero.
So how do they mathematically protect each other when combined?
VPED seeks a very rare, overlapping anomaly. You scan the market for a stock that possesses bulletproof fundamental PED characteristics, a massive earnings beat, raised forward guidance, huge fundamental cash flows. But simultaneously, you analyze its options chain, and you look for a completely distorted, right-skewed volatility surface with massive open interest stacking.
You want the best of both worlds.
Because their strengths cancel out their respective weaknesses. The fundamental slow drift of the massive pension funds buying the stock every day provides an incredibly strong price floor. That slow rise protects your options, contract against the devastating effects of theta decay.
Right, because the stock is fundamentally rising, which keeps your options' intrinsic value healthy.
Exactly. Meanwhile, the options skew the convexity, provides the rocket fuel. When that slow institutional drift eventually pushes the stock price high enough, it triggers the market maker hedging algorithms, igniting the gamma squeeze and delivering the explosive upside.
You get the structural safety net of corporate fundamentals combined with the asymmetric payout profile of a lottery ticket. It's genius.
It is the apex of quantitative trading. And the sources outline a highly disciplined three-step professional workflow to actually execute this in the wild.
Step 1 is the fundamental filter.
You never, ever guess before an earnings report. You wait for the data to drop. You run a scan looking for a stock that gaps up more than 10% on the opening bell, accompanied by trading volume that is 3 to 5 times its normal historical average.
And that massive volume is the undeniable footprint, proving that the institutions have noticed the earnings beat and are beginning their multi-week accumulation phase.
Exactly.
Step 2 is the volatility scan.
Once the fundamental filter triggers, you immediately pivot and check the options chain. You are looking for skew inversion, where calls suddenly become wildly more expensive than puts. And critically, you must verify IV stickiness.
Stickiness. We talked about Ivy Crush earlier, the idea that volatility drops after the news is out. So what does sticky Ivy tell us?
Usually, after an earnings event, implied volatility crashes because the unknown catalyst is in the rearview mirror. But if a stock gaps up 10% on earnings and the implied volatility doesn't drop, If it stays elevated or even continues to climb, that is a massive flashing neon sign.
It tells you the market is not relieved that the event is over.
No, the market is absolutely terrified that the stock is going to run away from them. The fear of missing out overrides the relief of certainty.
Okay, step 3, microstructure entry.
This is where patience separates the amateurs from the professionals. Even if a stock perfectly passes step 1 and step 2, you do absolutely nothing on day 1. You do not chase the gap. You wait.
What are we waiting for?
You wait for the day traders, the algorithms, and the retail tourists to get bored and take their quick day 1 profits. You wait for the stock to experience a natural, healthy pullback over the next few days. Specifically, you wait for a day where the trading volume shrinks to below 30% of the volume seen on the initial breakout day.
Ah, the shrinking volume pullback.
Yes, that is the mathematical signal that the weak hands have exited, the selling pressure is exhausted, and the institutions are ready to resume their buying. That is your exact entry point.
Let's apply this workflow to the live targets the sources evaluated in May 2026. Give me the perfect VP candidate from that dataset.
The absolute crown jewel was ARM Holdings. They delivered a massive earnings beat on May 6th. The stock gapped up on huge volume, confirming the fundamental PED. Then, when you ran the volatility scan, far-dated calls at the $200-plus strikes were heavily, aggressively right-skewed with sticky fins. ARM possessed flawless fundamentals and explosive convexity.
And AMD was another prime target.
Yes, strong earnings, followed by that massive July event option stacking we discussed.
Okay, those are the winners. But what about the anti-targets? The stocks that look fantastic to a retail trader, but instantly fail the rigorous VP test.
The perfect example of an anti-target is Team Atlassian. Team delivered a very good earnings report. The stock moved up. But when you opened up their options chain, the volatility surface was standard, boring left skew. The out-of-the-money puts were still significantly more expensive than the calls.
What does that tell you?
It tells you that while the market respects the earnings, absolutely no one is terrified of missing out on a massive, exclusive upside run. The big bunny was still prioritizing downside protection. There was zero convexity potential and no gamma squeeze setting up. If you bought teen calls, you were just buying a slow stock.
What about CRWD? CrowdStrike, they're always a retail favorite.
CRWD exhibited incredibly strong fundamental momentum, but its IV skew was totally flat, totally neutral. It lacked the extreme FOMO of its direct competitor, PanW.
Palo Alto Networks. Why did PanW have the skew?
Because PanW's CEO was actively, publicly buying up millions of dollars of his own company's shares on the open market, which completely ignited the options market and created massive right skew. A strict VP trader would look at that data, totally avoid Team and CRWD, and concentrate all their capital into ARM, AMD, and PanW.
It really is like having X-ray vision for the stock market. You aren't just looking at the two-dimensional price on a chart. You are looking at the three-dimensional mechanics of the massive players physically pushing that price. Which brings us to our final overarching theme, following the smart money.
Ultimately, every single concept we have unpacked today, the survival architecture, the zero-to-zero budget, slicing risk with spreads, extracting yields with the TCR, decoding right skew, and synthesizing VP'd, it is all just a unified framework for tracking and exploiting institutional footprints.
Oh, right. And I think we need to fundamentally redefine what smart money actually means to the average person, because the sources are very clear. Smart money does not mean they are psychics. They don't have a magical crystal ball that tells them the CPI number before it drops.
Not at all. They are caught off guard by macro shocks, just like everyone else. Smart money simply refers to massive entities. Trillion-dollar pension funds, sovereign wealth funds, apex quantitative hedge funds like Renaissance Technologies or D.E. Shaw.
They aren't predicting the future.
No, they are just moving such an astronomical amount of capital that the sheer physical volume of their trades actively changes the supply and demand structure of the market itself.
The analogy I love for this is imagining the stock market as a busy harbor. Retail traders, you and I, are guys on little jet skis. We can turn on a dime, we can zip around, we can react to a news headline the exact second it breaks and change our entire portfolio. But institutions are massive, fully loaded supertanker cargo ships.
That is exactly how you have to visualize it. When a cargo ship decides to change direction, say because a blowout earnings report dictates that their models must add 10 million shares of AMD to their holdings, they cannot just crank the steering wheel and buy all 10 million shares on day one.
If they tried, their own buying pressure would rocket the price up so fast they would destroy their own average entry costs.
Precisely. So they are forced to break their orders up into tiny, algorithmic chunks. They buy steadily, relentlessly, over 2, 4, 6 weeks. Their massive engines are turning incredibly slowly. And as that supertanker turns, it generates a massive, undeniable physical wake in the water. That slow, rolling wake is exactly what causes the P drift.
And VP'd is nothing more than a highly optimized surfboard designed to ride that exact wake. But how does it specifically exploit retail behavior? Because the sources emphasize that VP'd actually requires retail traders to make an emotional mistake in order to provide us with a safe entry point.
It all comes back to the shrinking volume pullback we outlined in step 3 of the workflow. Retail traders are inherently emotional creatures. On day 1 of a great earnings report, they suffer from extreme FOMO. They rush in on their jet skis and buy aggressively at the absolute peak of the morning gap up.
Guilty as charged. I've bought the top of many morning candles.
We all have. But then 2 or 3 days later, the stock naturally dips a little bit as the initial excitement fades and short-term traders take profits. The retail trader, who bought at the absolute top, sees their account instantly go red. They panic. They think, oh no, it was a bull trap, the market is turning, and they emotionally sell their shares at a loss to stop the pain.
And who is standing on the other side of that trade, happily buying those dumped shares?
The top quantitative funds, the market makers, and disciplined traders utilizing the VPE framework. We specifically patiently wait for that retail panic selling to create a healthy pullback on shrinking volume. We absorb those dumb shares at a discount right as the massive institutional cargo ship is gearing up its engines for its week 2 and week 3 accumulation phase.
By combining the physical volume of the stock, which tracks the fundamental footprint of the cargo ship, with the IV skew of the options, which tracks the derivative conviction of the market makers, you completely filter out all the noise.
You really do.
You don't have to listen to talking heads on financial TV. You don't have to stress about Twitter rumors. You align yourself perfectly, mathematically, with the actual physical flow of institutional capital.
You stop trying to predict the chaos, and you just observe the physics of the market, structuring your survival and your attack around undeniable data.
Let's summarize the incredible multi-layered journey we've been on today. We started by building a concrete mathematical bunker to survive the devastation of a CPI black swan, learning to physically isolate our capital with zero-to-zero budgets and buying the oxygen of time to ride out the panic.
We learned how to tactically downgrade our tools, slicing our risk with vertical spreads to survive the inevitable IV crush and maintain extreme capital efficiency.
We analyzed the exact stress tests of May 2026. Seeing mechanically how smart money supported the deep V recoveries of DL and AMD while letting QCOM struggle on the tape. We explored the insurance business of selling puts, utilizing the theta capture rate to extract yields and flee before the gamma steamroller arrives.
Then we abandoned our defenses and went on the offensive. We hunted the most dangerous, most expensive lottery tickets in the market by decoding right skew, understanding how to weaponize delta hedging to trigger gamma squeezes.
And finally, we synthesized every single piece of this into the VP'd framework, marrying the slow, fundamental, inevitable momentum of institutional cargo ships with the violent, explosive convexity of the options market.
It is a profound structural shift in how you view the machinery of the financial world.
It really is. And as we wrap up this deep dive, I want to leave you, the listener, with a final, slightly provocative thought to ponder over your next cup of coffee. We spend so much of our time and energy in the markets absolutely terrified of the traditional black swan, the sudden crash, the unexpectedly bad inflation data, the geopolitical crisis. But looking at the massive explosive right skew in stocks like DL and AMD during that May 2026 data, what if the real risk isn't a crash?
That's the million-dollar question.
Right. What if, in a heavily institutional, historically capitalized, AI-driven market, the most dangerous risk to your portfolio isn't a sudden drop, but an explosive, gamma-driven upside black swan? A sudden, violent repricing upward of the entire market that leaves you entirely behind, starting on the platform, simply because you spent all your capital and emotional energy preparing for the end of the world.
Being chronically underexposed to generational convexity is the ultimate silent penalty of the modern market.
So tomorrow, when the opening bell rings, don't just look at the two-dimensional price of your favorite stock. Dig deeper. Take a look at its volatility surface. Look at the options chain. Look at the volume. And ask yourself, what is the smart money really pricing in?